Hey, good morning, everybody, and welcome to this Tuesday, April 16th, 2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we take a look at the action from yesterday, which was, it's been pretty bearish lately. Certainly another bearish day yesterday, but we'll also take a look ahead today and the rest of the week, looking for some potential signals of whether or not this is going to get worse, or whether we are getting ready to get an all clear sign to be much more bullish and much more aggressive. Literally, I kind of feel like we're sitting on a fence right now, and I'm kind of watching to see which way this thing tilts, but we'll talk more about that in just a minute. Actually, why don't we go ahead and jump in? Let's take a look at the action yesterday. Let's start this thing off, and we got some other things we can talk about as we move throughout the show. Yesterday, the Dow Jones Industrial Average finished down about 2/3%. S&P 500 down 1.2%. NASDAQ finished down 1.65%. And then we had the mid caps down a little more than 1%. Small cap IWM down about 1.5%. Transports only lost about 0.7%, but it was a pretty big loss because we did close below that 15,400 level, just fractionally, but this was the lowest close. If you look back at those last three times when we've gone down to 15.4, we finished above 15.4 in each of those. Yesterday, we finished down just below at 15,388. So that could be a harbinger of some additional selling ahead. That would not be good. And then we're going to need to watch 15.2, but I'll show you that on a bigger chart in just a couple of minutes. The technology sector took it on the chin yesterday, down 1.9%. Real estate down another 1.75%. Discretionary dropping 1.2%. So you see two of the aggressive groups in the bottom three. So where we had been kind of holding up okay in some of those aggressive areas, yesterday we saw a little bit more of a downturn. That's something to keep an eye on. Among the technology groups, I pulled up the three weakest. So there were some other areas of the market that did not do well. Real estate, holding and development, bad group. Automobiles, Tesla had another bad day. Automobiles were down about 5%. That was a rough day. But these three I just wanted to focus on because these were the three worst within the technology group. Renewable energy, which had been showing some really nice strength of late, moved to a 6-month high, as you can see on the chart. Did drop 3.5% yesterday. Software, which is one of the leaders, I actually was looking for software maybe to take a big jump out of what looked like an ascending triangle pattern. Instead, we dropped, lost the 50-day moving average much more definitively. And now I would be looking maybe at that initial low that we saw back in February, down around maybe 6,350, 6,400. That's going to be a level to watch pretty closely because you can argue with equal tops that equal lows to the downside would just simply be sideways consolidation. So software could be moving from an uptrending group to a sideways consolidating group. Hard to make a bullish argument, though, if that level in the near term breaks. I mean, I can go back and look at weekly charts, but I'm talking about in the near term for traders. We start seeing some bigger breakdowns in some of these key areas, especially with the volatility index where it is. And we're going to talk some about the volatility for sure. That combination, a lot of times can lead to very significant short-term losses. Anytime that VIX gets up above 20, some of these aggressive groups are at or near support. They start breaking down. The selling can escalate pretty quickly. And I've always said that a VIX over 20 is a much more difficult market to trade than a VIX under 20, especially a VIX under 17. And I've got a chart on the VIX I'll show you later to kind of help explain that as well. But overall, yesterday's action was not very good. We actually started off good. We were up in the morning, but I always look to see maybe some additional weakness whenever we finish down near closes and so forth. And so I wasn't exactly bullish when we opened at yesterday's or during yesterday's session, because a lot of times that tends to be very temporary. And then you come back down and you at least set a new low before you go higher. I don't like seeing a bottom form on one day's candle where all of a sudden the next day we gap up and start going higher and never look back. It happens, but that's not the normal way we see bottoms form. So I like to at least see a new intraday low printing. This morning, we've got futures up. Well, we've got futures mixed, I should say. We've got the Dow Jones. Let me give you the numbers there. Bank of America came out with a nice report, and as a result, we did see some of the larger banks and some of the indices that are driven a little bit more by financials, at least large financials, doing better. Right now, we have the diamond in pre-market up about 0.56%. So closed yesterday at 377.31, and today trading at 379.42. The S&P 500 up 0.15%. So a big drop from 0.56 to 0.15. So the spider doing a little bit less, or having a little bit less bullishness this morning, if you will. The QQQ tracking the NASDAQ 100 up 0.08%. And that was up a little bit more earlier this morning. So already we're seeing a little bit of a drift, and we haven't even opened yet. We still got 25 minutes to go. The IWM, which has really been taking it the hardest lately, down another 0.55%, another 0.5%, a little bit more than that this morning. And one of the big problems for the IWM, no doubt, is that short-term 10-year Treasury yield rising. Higher interest rates, I think, if you look back at the charts, it's been almost a mirror image. IWM's really struggled when the 10-year Treasury yield's been going up, and it does much better when that yield's pulling back. We'll take a look at that Treasury yield because we did hit a key area, a key target, which maybe will signal a top, but we need to see more confirmation on that before we get excited. Anyway, yeah, I mean, futures kind of mixed there, as you can see. So we got the Dow up a little more than 0.5%. We got the IWM looking to open down a little more than 0.5%. Both the S&P and the NASDAQ slightly in positive territory. Let's go on and move on to the 10-year Treasury yield. So let me give you an update here. Right now, we are at 4.657. So basically 4.66%. And if we turn on this inspector button right there, and we go back to this high, which is back on February 22nd. Let me try and zero in here for you so you can see this. So on February 22nd, we had a high of 4.35% on the yield. We went down to a low of 4.04%, roughly. So that's 31 basis points, dropping from 435 to 404. Now, this comes off of an uptrend, and then we came right back up and we put in our high at 435. So 435 to 404 to 435. That is a rounded cup. We went back down, tested the moving averages. Normally in a cup, you don't want to see more than half of the cup lost during the handle. Here, 435, 404, that's 31. So right in the middle, let's say 404 plus 15 basis points would be 419. We came down to 418 both days. So almost squarely right in the middle of that cup. And then we turned higher. We broke out. We have not lost the rising 20-day moving average since then. So we had a bullish breakout. I said back then it measures to 466. And in this pullback, we held the 20. And yesterday, we hit a high of 466. Today's high, 466. So when I say that maybe we reverse and start to head back down, it's because the target's been met. Doesn't mean it has to stop there, but that's the initial target. We've achieved that. Let's see what happens from here. Now, as I go back and I try to look to see where other areas like key resistance levels were, when we first started to move lower back at the end of October of last year. Now, again, top in the 10-year Treasury yield kind of coincided with the nice rally that we had in equities. Had a big drop from 5% all the way down to 3.78%. That was a big tumble in the 10-year Treasury yields, and that helped a lot of gains at the very end of 2024 or 2023 and into 2024. In particular, we started seeing financials, industrials outperforming, and we saw money beginning to rotate away from the more aggressive sectors like the technology group, communication services, consumer discretionary, but still aggressive groups were doing well. They were all moving higher. It's just that the leadership kind of moved and rotated a little bit, which isn't bad. In fact, it's a pretty good thing during a secular bull market. So this drop in yields kind of helped facilitate that. Since the end of December, we went up, we came back down, and it was really around this time when we started to make a more defined move to the upside. That's when we started to see more rotation away from some of the aggressive areas into financials and industrials, which continued to do well, and energy and materials. Energy and materials have been a big winner over the past couple of months, helping to keep the market afloat to some degree. Now, they're not heavily weighted in the overall market, probably between the two. They're under 10% of the S&P 500. So it's not, huge, but when you get financials and industrials helping out, that is what kind of held the market afloat, because we saw some weakness in some areas of technology and so forth. And we've kind of had to go through that process, which is somewhat typical when you get into the second half of each calendar quarter. So, any from mid-February to the end of March, or from say mid-May to the end of June, or mid-August to the end of September, those 3 quarters, that period tends to be a period that doesn't do as well as the first half of the quarter, and also tends to see some rotation into more value-oriented areas. So some of what we've seen to date, at least leading into April, was kind of normal. Sideways action, maybe a little loss here, but a little bit of gain somewhere else. But overall, market not really doing much. That's consistent with its historical pattern since 1950. What we're seeing, though, here in April with 10-year Treasury yield moving up, the VIX has been moving up, stock market's been moving down. This is not normal behavior. And so I've kind of got my eyes open watching to see what's leading, what's not leading, how high this VIX goes. I think this is going to be a really important question. And again, I'm going to look at the VIX here in just a couple minutes. But there are definitely more questions building in the market in the near term. And we've gone on the VIX from 12 to 19 with very little damage. I mean, finally, yesterday, we did see some breakdowns on some of the indices in terms of breaking below the 50-day moving average. But that move from 12 to 19 is about a 50% move. And until yesterday, we really hadn't seen much damage at all in our major indices, despite a 50% rise in the VIX, right? Well, I can tell you that if we get another 50% rise in the VIX from where we are right now, and we go from 19 or 19 and change, and we get up anywhere near 30, I can promise you that the damage on the major indices is going to be a lot worse. And that's what I've always talked about with the VIX. A lot of people just get in, oh, VIX is low, that means it's bad for the market. That is not true. It can be true, but there are a lot of times when the VIX is low and it stays low for a long time. And if you think that's bearish and you get out of the market, you're going to miss some of the biggest runs in stock market history. So just because the VIX is low isn't a big problem. The problem is when the VIX gets up to 20 and doesn't stop going up. So we are in that range where we're going to have to be paying a lot more attention. Anyhow, I'm going to show you a chart on that in just a little bit. Just be patient. We'll get to that. S&P 500. So let's take a look at the damage that was done yesterday. Starting off, I mean, it's hard not to see a big red candle breaking below the 50-day moving average. When you look back throughout this rally, not only had we not seen a big breakdown of the 50-day, we had not even seen a test of the 50-day since back in the second week of November. So let me just say this, because I know a lot of folks are getting really bearish. If you take, I'm going to annotate this. If we connect these lows, trying to kind of look for a channel, probably something along those lines, maybe, or even just a trend line. But there's a lot of folks that look at a trend line like this and they say, wow, if this breaks down, this is really bearish for the stocks. I think temporarily that it's bearish. I don't think necessarily long-term it's bearish. And the reason I say that is this trend is unsustainable. The percentage gain from November, early November along this line, even if you calculate to where it broke down around 5,200, from 4,350 to 5,200 is 850 points, which is about 20% on the index. Now, this 20% right here, this 20% gain takes place in over 1, 2, 3, 4, 5 months. So how sustainable is it for the S&P 500 to go up 20% every 5 months? That would be 40% every 10 months and would be probably about 45, 46%, whatever that works out to over 12 months. Actually, it would probably be about 48%, I think, over 12 months. That's unsustainable. The S&P goes up 9% a year. It doesn't go up 48% a year. So at some point, this trend line was going to break. That was inevitable. The fact that it broke the trend line does not mean that we're in a bear market. We could certainly establish another trend line that is much more friendly from a longer term perspective. And I don't know where that would be. I mean, we could go back into a longer chart, but maybe if we go down, we test 5,000. That right there from 4,100 to 49 and change is a little bit more palatable, still too high. I mean, maybe we end up coming down 4,800, 4,900. I think at the beginning of the year, now we didn't have the March weakness that I thought, but at the beginning of the year, I had said, I think 4,700 or thereabouts, that we could probably have about 4,700 to the downside. And then more recently, I said I thought 4 to 5% is what we would be looking at. That would take us down to around 5,000. Now, whether or not we hold 5,000 is going to depend a lot, in my opinion, on the VIX and whether or not the volatility index settles down. What the VIX does, it's a little different than looking at the put call ratio or looking at the AAII survey, any other sentiment indicators. The VIX is a little unique in that, number one, it's based on the pricing of short-term S&P options. And as the VIX goes higher, it's telling you market makers are the ones that price these options. So it's giving you the market maker's view, not options trader, retail traders, which is what I like to follow, the CPCE, not portfolio managers that might fill out one of these surveys. This is the market makers that price options. And so when they start pushing that VIX up above 20, that's telling us that they are anticipating, first of all, they're the ones that have half the time create the volatility. So if they're telling you that they're anticipating it, then you've got to at least be aware of it and recognize what it can do to stock prices in the near term. Again, getting up to 17 when you're low on the VIX, that can be fine. Even getting up to 20, which is about where we are right now, sometimes is fine. Get through 20 and a lot of things can change. So anyway, recognize the breakdown on the S&P 500. NASDAQ 100, recognize the breakdown. Again, closing back below the 50-day moving average, first time since back in November. We'd kind of been slowing down to the upside. This is where a lot of that rotation came in this year. A lot of money moving into financials. And if you follow the NASDAQ 100, you know there's almost no representation of financials in the NASDAQ 100. So when the financials were leading to the upside, it makes common sense that the NASDAQ is going to take a little bit of a pause on a relative basis. But a pause and sideways consolidating is a little bit different than a breakdown like we saw yesterday. Now, volume was moderate. I wouldn't say it was huge, but it wasn't light. And we want to keep an eye on that, because if the volume accelerates on this move lower, then we need to start thinking more about conservation of capital, protecting our capital as short-term traders. Again, I want to emphasize the difference between, if I'm somebody that's very passive in the market and I don't really follow the market day to day, I don't want to trade today, I don't want to get out today, get back in tomorrow, get out next week, get back in the following week. If you're more passive, honestly, to me, I would just ride long, would not pay any attention to this. I believe it's a blip. I don't believe this is a long-term top, and I'm definitely in disagreement with many others who believe that this is maybe the start of a big decline. I don't believe that. Could I change my mind? Sure. I mean, let me keep watching my signals. But for now, I think it's more of a short-term decline. And I think whether it goes down any further from here, a lot of it is going to be dictated by the volatility index. But anyway, got to recognize, I mean, I'm not going to look at this chart and say, oh, everything's fine. Clearly, on a daily chart, we have broken down. We've taken out some recent lows. And that's uncharacteristic for what we have seen over the course of the last 5 or 6 months. So definitely a change in character in the market. But this is the daily chart. We're going to go look at some weekly charts in a minute. IWM, the worst of all right now when I compare to the NASDAQ and to the S&P 500. And as I've said, I think this one is much more impacted by that 10-year Treasury yield. I think, when I made my bullish call on the IWM, and I'm still sticking with it, I think it's been delayed. I'm looking at this market right now a little bit like I looked at the market in August of 2022, when we had what looked like a bottom in June. S&P went up 700 points, and then we had the Jackson Hole speech. Remember, Fed Chief Powell said more pain ahead. And that changed everything for a short period of time, because ultimately we got to the bottom. Inflation wasn't a problem, as we started to peak on that inflation, roll over, and then the stock market took off. So it delayed what I thought we were starting back in June. So temporarily I was wrong. I called a June bottom in 2022, if you recall. October, we ended up hitting a new low. So technically that call in June was wrong, but I still think it was a pretty good call. Anyhow, when I'm looking at the market right now, I'm seeing something similar. I'm seeing what I think is lower rates ahead. I see inflation moving back down toward the target rate. PPI is already down there. CPI has been more stubborn, mostly because of rents, but is one of my, I think maybe somebody that was viewing on YouTube maybe posted, I don't recall, but they mentioned something about auto insurance. No doubt, if you've seen auto insurance, you know what is being referred to there. Definitely, those are a couple of keys to keeping consumer inflation high right now. So we'll need to see those coming back down. But ultimately, I see that coming back down. And again, that's just my opinion. A lot of folks disagree with me, and that's fine. That's what makes a market. You pick your side. But if we do see inflation start to pick back up and rates go even higher, and the Fed starts talking about, hey, we might have to hike rates instead of cut rates, and I'm not talking about one member, I'm talking about the overall group, that would be a monkey wrench in what I see down the road. So if you're wondering, okay, what would make you change your mind about the market? Well, short term, number one, it's going to be the VIX. I've said many times before, I don't mess with a market that has a VIX over 20. Don't do it. And we're at 19 and change. So you know how close I am to pulling the trigger and sitting out and watching this. That's number one. But that's short term. Longer term, I need to look at the sentiment, other sentiment indicators that I like to follow. Let's see on this selling, conditional or additional selling, what areas of the market are leading to the downside. That's going to be a major factor. Also, how much of the move, when we ultimately make a bottom, how much of the move was in gaps and in short-term, early morning trading? All of those are going to be factors in helping me determine what kind of a sell-off. If this is full-on distribution, the VIX is over 20 and we got a lot of distribution, then my longer term might change. But we got work. I got to see a lot more than what we're seeing right now. Anyhow, IWM pulls back. I want to show you the weekly chart here. Okay, so we're at a pretty important stage on the IWM, looking at a weekly chart, because what I believe is once we took out this triple top, that we had a clear uptrend in play. And on a long-term weekly chart, that rising 20-week moving average needs to hold as support. Now, we don't get a final candle on a weekly chart until Friday. So yes, this is breaking down intra-week. Look back in September of 2020. We also had an intra-week breakdown. But what happened by the end of the week? We left a long tail below the 20-week. We closed at the 20-week. And what happened afterwards? Literally 2 weeks later, we were back near that all-time high. So these turnarounds can be very, very quick. So we've got a potential breakdown, and this is why I don't like trading a high volatility market, because I could see things accelerate quickly, or I could see this as one of the best buying opportunities that we're going to get in 2024. And the difference is literally like a hair. It's like splitting a hair, because we're literally right at that level, that VIX 20 level, the weekly 20-day or the 20-week moving average on the IWM. All of these things are coming together all at the same time. Which way is it going to go? If you call it wrong from here, it's going to hurt. So if you say, well, I think it's bottoming, I'm going to jump into leverage. If it goes the other way, that leverage position on the long side is going to be painful. Just warning you, letting you know. It's not going to be like it's been the last few weeks where it maybe goes, buck or two. I mean, if this market starts to go lower in a hurry, you could see those leveraged ETFs really falling quickly. Just keep in mind, you can make a lot of money with them, but you can lose a lot of money with them. And that's the second part, is what a lot of traders don't think about. Same with going short on leverage. It's not just going long. If you go short on leverage right now, so, something like the SQQQ, triple the NASDAQ to the downside, if you do something like that and this market prints a hammer on the 20-week and shoots back up, it's going to be a really painful leveraged ride on the short side. You got to get it right. And it's not easy when the VIX is up near 20. I like to see some sort of a big reversal on the VIX. And again, we'll get to that in just a minute. But do we hold this 20-week moving average? That, to me, is the biggest question of the week for the IWM. Nothing else to me right now matters. Does that weekly hold? Because if it doesn't, the odds are increasing a further downside. Let's see. NDX, we talked about that. IWM trans. Here was the triple bottom that I was talking about at 15.4. Closed at 15.388. Closing below those levels. Now we've got this bigger level, and I'm going to annotate it just so make sure you understand why I believe this 15.2 level is so important. So on this downtrend, this was the final high before the final low. We came all the way back up. We tested it. Normally, notice what happens in a downtrend. Low, lower low, lower high, lower low, lower high, lower low, lower high, and it looked like it was rolling over. And then we made this move up and we tested. We never went back up and tested prior highs. We just kept going lower highs, lower lows. This was different because we went back here and we tested the previous high. Then we moved back, and what do? We hold the 20, in this case daily, it's a daily chart. So we hold the 20-day moving average, printing now what looks like an inverse or reverse right shoulder. Left shoulder, neckline, head, neckline, right shoulder. And then we broke out. We broke out, and on these couple of days, you can see the volume picking up, bigger volume, breaking out, confirming that breakout of 15.2. Notice every test back at 15.2 has held. We've been consolidating now sideways for probably 4 months in transports, maybe a little over 4 months, something like that. Anyhow, 15.2 would be a significant breakdown. Now, a long tail below 15.2 and a close back up over 15.2 would be a potential bottom. So candlesticks are going to be important to follow here over the next couple of days. But watch 15.2. That's going to be a big level upcoming on the transports if we continue to weaken. All right, let's talk about the chart of the day. For those of you that are new to EarningsBeats, you can try us 30-day free trial. Click on that button, start your 30-day no-cost trial. If you just want to learn more about us, if you're new to the show, first of all, welcome. We'd love having you on here. Check out the EarningsBeats Digest. That's our free newsletter. Name and email address, all it takes. Subscribe with just that. Don't need a credit card. I think you'll learn a lot. Probably will help in your trading. Provides education. Going to provide some guidance, market guidance. So make sure you check that out and sign up. So what's the chart of the day? Well, I had to pull up the VIX. This is a 10-year weekly chart. And what you're going to see is if you connect every one of these spikes in the VIX, if you look at where the S&P 500 is after each one of these spikes, you're going to see that it is almost squarely on its low. So the good news is if you can catch the top in the VIX, you can catch the bottom in the market. And there's a lot of folks out there that say, oh, the time to buy in the stock market isn't when the VIX is low, it's when the VIX is high. True to some degree. True if you happen to get the top right. If you think that this is the top at 17 and you jump in and then you have this day where it goes up to 50, you're not going to be feeling very good about that long. Trust me, that move on the VIX, that was back in early 2018, but that was a lot of fear and the market took a big hit when we saw that additional move up in the VIX. How about here? It looks like the VIX at 25 is topping and rolling over, right? So you jump in. Well, guess what? The VIX went up again. And look at the big move lower. This was the trade war at the end of 2018. Again, if you just look across, if you get the ultimate top right in the VIX right here, come down, October low, look at this. If you got in right on that low, you were great. If you got in on this low, you were great. If you got in on this low, you were great. But this is going up right now, and it doesn't show me any signs of any kind of reversing. A lot of times these tops, you'll see these long tails on the VIX. In other words, intraday, morning, think morning, market getting killed, VIX is spiking, and then the bottom forms and the stock market turns up, the VIX comes back down and leaves a long tail. A lot of times when you see these tails start to form, it's one indication. Doesn't guarantee. I mean, I've seen tails before. I mean, you go through, I don't know, if you look through some of these, you might see a tail and the next day it puts in another tail up above it, meaning the market went down again. So it's not a perfect science for sure, but that's what I'm looking for. I'm looking for something where we see that VIX go up to 20, 21, 22, 23, and we get a little more panic in the market and then we reverse. And that is when I would consider using leverage, but you've got to be willing to let it go if you're wrong. If that VIX pops again and you go down to another low, you got to be willing just to take that loss. And when you're trading 3 times the underlying index, that loss, even though the index itself may only be 2 or 3%, if you're 3 times that, you're looking at 6 to 9%. And if you got to take that kind of a loss in 1 or 2 days, that can be really depressing. So trading leverage is not for everyone. That's for sure. But anyway, now the VIX is moving up, spiking, and you can see the market going down. How far is this going to go? Some might say, hey, we're going all the way to 3,500. Okay, if that's what you think. Some might say, well, we're going to go to the breakout level, 4,800. That's more plausible. I don't know if we go down that far, but we could. We certainly haven't really gone down and retested it since we broke out. So that 4,800 is possible, especially if that VIX gets through 20. We could be at 4,800 a lot faster than you think. But the VIX, I think, is the one chart that I'm going to be watching the closest. Because honestly, when the VIX gets up above 20, it's irrational. I don't like trading because I don't like to trade in the irrational market. So, I mean, anything goes. Literally anything goes when that VIX goes through 20. To me, it's not about anything, rational that you want to talk about that, hey, this market should go up from here because of this. VIX over 20 doesn't matter. VIX over 20 means not necessarily panic, but you're starting to get a lot of increased concern at 20. You start getting up near 30 and you're starting to talk panic. So again, moving from 12 on the VIX to 20, yeah, we have a little blip. But when you go from 20 to 30 or 35, you can see the decline starts to get a lot steeper. So that's why I always say when the VIX is under 20, I'm good. VIX goes over 20, I want to be a little bit more careful. So that's what we have to deal with. This is last chart I want to show you. The market opened 5 minutes ago, and we'll take a quick look at the opening here in 1 second. This was an article I wrote back in November of last year. And we were just starting, and a lot of folks were like, oh, well, this can't last. And a lot of folks back then were saying, definitely you don't want to jump in November, after we've already made a move higher because, fill in the blank. Well, I published this and I showed a chart of the VIX, and I actually went back and I looked at how the S&P 500 closed or traded when the VIX closed at various levels. So here I calculated every day that the VIX was below 13. And when you look at the performance of the S&P 500, anytime you're closing below 13, your average annualized return on the S&P is 47%. Between 13 and 17, if the VIX is in that area, the long-term annualized return is 30.97, almost 31%. When you get to 17 to 20, this is where we are right now. I kind of got this yellow, kind of cautious tone because now the annualized return drops to just 15%, which is barely above the longer term 9% level. I mean, here you can see triple, more than 5 times the return when the VIX is down here. When you get to 17 to 20, you still have outperformance, but it's a little dicier, more volatility. When you get above 20, or every day the VIX is closed above 20, some of these days the VIX is going up and you're getting killed on the S&P. Other days you're going down in the VIX, but you're still above 20. All of these days were counted. Didn't matter whether the VIX going up or down. If it closed above 20, it was added into this calculation. The S&P 500 annualized return is minus 36.74 when we have a VIX over 20. That's a far cry from these others. And this right here is why, from a trading perspective, when we go over 20, I tend to move to cash. I mean, there's a chance, depending on what happens today, I could move to cash. And I might be right back in fully invested Wednesday or Thursday. But if we go through 20, I don't want to be in it if it goes from 20 to 30. I'll let someone else be the hero. Maybe it goes to 40. We don't know where it's going to go. All I know is when it gets above 20, a lot of bearishness can kick in to the market. A lot. We may have gone down 3 or 4% now with a VIX at 19. But if we go to 30, we may have that 10% correction. So there's a lot of things you have to be thinking about there. But I don't like, as a trader, I don't like to trade a market where the VIX is over 20. Some might disagree with me, especially if you're on the short side. You want a VIX over 20. You want it badly because that's when your bigger down days will occur. So we'll see what happens. Anyway, let's take a look at the major indices. Just see if we're holding on to the gain on the Dow. Dow's doing well. S&P, NASDAQ, small caps, all down. Small caps down another 1%. So I don't know what that 10-year Treasury yield is doing, but we'll take a quick look. It's up near 470. That right there is not good news for small caps. And that also, there's the high, 4.696. There's the high there, 4.703. And right now our high today, 4.696. If this level goes, I mean, right now you're just stair stepping over 466. You got 470 here. You got the top of gap resistance at probably about 479. And then you got 5%. And as this goes higher, if it goes higher, not going to be good for equities. So, and especially small caps. So I will be waiting to see what kind of a finish there is to this week. Because again, that weekly chart, on the IWM, is this a breakdown? I mean, if we update it, you can see it's now even down further. Is this a breakdown of the 20-week? Or are we going to get a head fake that looks something like that back in September? I'm not predicting one way or the other, but I'm going to be watching because it's going to make a big difference, I think, in how the market moves forward. Anyway, wish I had better news for those on the long side, but definitely a rough day yesterday. Rough start this morning. Look for either reversals, primarily on the VIX. Let's see where that VIX is, by the way. Probably above or getting close to 20, I would think. Now 1917. We were down earlier, though. Remember, futures were up. So we were down earlier to about 1839. And then we came back up 19, or 119.56. So that's the high, but that's above yesterday's high. So the VIX probably, I mean, I don't know what's going to stop it here. I think we're going to see it hit 20 and move into the 20s. And then the question is, what does it do from there? Does it close above 20? Does it just peak? I mean, you can see here this day, this was back on February 13th. We had a VIX got up to 1794, closed all the way back at 1585. And then we saw the VIX settle down as the market went higher. That kind of a candle is what you look for. But here was one, and this is what I was talking about earlier. You get this VIX with the long tail, looks like, hey, maybe we're reversing, and next day you go up to a new high. So trying to catch the top on the VIX is not easy. Sometimes it's like whack-a-mole. You know, you got it, you hit it, and then it pops up somewhere else. Next thing you know, you're at a higher VIX. So this week could be really intense. Trying to look for the right word. I mean, if the VIX keeps climbing, it's not going to be a good week. So let's see if we hold 20 to the upside. Let's see if by Friday we get any kind of recovery in the market. If we don't, we're going to see some big breakdowns in probably a number of areas, but especially on that IWM. All right, that's it for me. Everybody have a great day. Happy trading.